Hello and welcome to another in the Fundamentals of Securities Lending series. I'm Roy Zimmerhansl, I'm your host. And have you ever wondered how a lender determines which of its clients gets a loan when an opportunity comes up? Well, that's what I'm going to be talking about in this video today. So if you are a lender or a borrower, a service provider, or maybe you're just interested in learning more about securities lending, then this is the place for you. So let's get to it. I'm Roy Zimmerhansl. I'm practice lead at Pierpoint, where we advise all kinds of market participants from lenders to borrowers to technology providers and other consulting entities on the nuances and the trends, issues, and challenges thrown up by securities lending. So as always, I've got a slide deck. This is what we're going to be talking about today, the fair distribution methodology for allocating supply to demand. First, let me say hi to Fanny. Thanks very much for showing up. I really appreciate you joining us again this week. I know that one of the things that you really like is the slides from the series. So I'm not sure if everyone knows this. You can actually download the slides from not just this episode, but previous episodes, all of them, by going to that link and signing up. Now, the reality is you actually don't download them. We send them to you. So that'll be a day or two and then weekly afterwards as we do the session. So if you're interested in getting the slides, just go there and sign up. Now, what have we been talking about and which shows am I referring to when I say you can get the slide decks from the series? So this is what I call the pathway to understanding. This is week number 30 out of the past 32 weeks. I took one Saturday off and one Saturday we had technical problems. So that was beyond my control. So today we're talking about fair distribution allocations. That suggestion, that subject was made by one of our newer but very loyal and very active viewers. So Amal, you know who you are. Thanks very much for that. And also I've taken your other suggestion, which is looking at collateral, tri-party versus bilateral, and the challenges that that faces in determining how trades get processed, settled, and then managed subsequently. So this talks about the different topics from each week. Sometimes we have multiple videos on the same topic because they can be quite complex. And up here, you can see this is the YouTube channel where hopefully you're on, and you can see that. If you are watching some other way, then go there to that channel for all of these slides. And again, I've just put it up so maybe it's a little bit easier to read in that caption there. So just have a look, go there. And what we're going to be talking about today in episode 30 is this whole idea of the fair allocation of loan supply. So we're going to talk about what the key question is, the thought process in determining how you make that allocation, the different approaches that some of the market participants use, the challenges that allocations throw up. And then I'm going to leave you with some thoughts and questions because the existing process isn't perfect. Nothing is, and it should be part of an iterative process to develop over time. Now, of course, as it says at the bottom, this is for information purposes only, and maybe a little bit of entertainment. I don't know. I don't really tell jokes, so maybe it's not that entertaining. Look, always seek professional advice. That's what we do. There's other advisors to the market as well. There's professionals like tax advisors. There's obviously lawyers. There's lots of people around this ecosystem because although securities lending isn't rocket science, it is incredibly nuanced and very complicated at times. Okay, so always speak to a trusted advisor. Now, one of my goals and objectives is to educate the world on securities lending. Look, it's becoming a much more globally pervasive activity. That means that there's more countries involved, more people involved, and events like GameStop and the meme stocks this year, I think securities lending has actually reached a whole all-time high in terms of general public awareness of the practice. Whether that's informed or not, Maybe not always the case, but that's why we're here. So look, if you like this, please give us a thumbs up or a like or whatever the equivalent is on the platform you're watching. If you want to see future videos, please see subscribe. But the key thing that I'm trying to do is get to 500 subscribers, because when I get to 500 subscribers on YouTube, then YouTube opens up the community challenge. And I'm really looking forward to that, because there we can share even more free content, answer people's questions, and build information, knowledge, and sharing as part of the community. So I'm really keen to host that for the benefit of the wider community. And I need your help. We've got 10 new subscribers this week. Look, none of this is going to compare to any of the big channels, but that's okay. I'm not interested in those big channels. I'm interested in people that are interested in securities lending. So I've got 120 to go. Hopefully we'll get there soon, and I can share even more information on that. So that's what the goal is, get to 500. Now, turning to the allocation process, one of the challenges is many institutional portfolios are very similar to other institutional portfolios. And so what happens is, if you have two portfolios that are similar, that both go into a lending program, they're most likely both going to hold Apple stock. And so when a new loan opportunity comes in and someone wants to borrow Apple, how does that lending intermediary that services those two portfolios determine which client gets it? Should they share it? Should one of them get it? What happens to the other one that didn't get it but could have done? So that's really the issue of allocation and the challenge. And investment portfolios are similar because most of the money is in the large indices. Well, of course, that's how they become large. And so that's the big cap stocks in most markets. There's lots of holdings in there, and lots of them are available in lending programs generally. It's what we call general collateral, widely available securities that can be loaned out for many different clients for any sort of borrowing demand. But the mid cap, small cap stocks, less well populated because there's less money in them. That's why they're not big cap stocks. And the portfolio managers themselves have peer group competition. Their job is to beat their competition. So if you have a mutual fund focused on an S&P 500 that you're trying to outperform on, then that's your goal and objective. So if you have a portfolio of US securities, then you're going to probably track much of the core part of that the same as your competition that has a similar mandate, but you want to outperform a little bit. But your major concern actually is not necessarily outperforming, it's actually underperforming your peer group. So that's your real challenge. And because the fear of loss and getting fired or losing investors is greater than the desire to have more investors, just human nature, what happens is many of these portfolios end up very similar because no one wants to go out too much of an extreme to differentiate themselves. They want to differentiate themselves a little bit and hope that they're right. And of course, passive portfolios themselves, they also add to this sort of accumulation of duplicate assets. So what you end up with in most lending programs is securities that are available that are just hugely repetitive. And that becomes a challenge because similarly, in the same way that most of the money is in the big cap names, on the borrowing side, where short sellers often are looking to find differentiation, find information that isn't widely available to bring a different point of view than the mainstream, frankly, that's hard to do on the big cap stocks. So because there's so many people invested in them, there's so much coverage of them, there's so much public disclosure those companies have to make, so much scrutiny on their activity, it's harder to differentiate on the big cap stocks. So it's the mid cap, small cap stocks, and of course, in different countries around the world. And so the challenge here is, how does a lender that's acting as an intermediary on behalf of multiple underlying clients treat their underlying clients appropriately so that they generate sufficient revenue to be part of the program? So as it says at the bottom, the problem is that for most loan opportunities, there are multiple investors that can make the loan. And so the question is, how is a loan allocated to an investor? So the thought process behind that is, the goal, of course, is that an investor that's participating in a lending program gets a reasonable proportion of the income that's generated in that program, and it should be roughly in line with how much they represent out of the entire lending program. So, for example, if an investor is 10% of an agent lending program by asset value, they would probably, not unreasonably, expect to generate about 10% of the income from that program. So that's the theory. But of course, there's lots of different challenges. Number one, portfolios are similar, but they're not duplicates. So two similar portfolios will generate different returns just because their actual composition is different. More importantly, investor risk appetites are very different, and that manifests itself through counterparties, through collateral choices, through their exposure limits. So let me give you an example. You have these same two lenders with very similar portfolios. One of them is much more narrowly focused in terms of which counterparties they will. An agent lender might have, say, 50 borrowers or 100 borrowers, and investor A only wants to lend to 80% of those because they don't know, or they don't like, or they don't have a relationship with that other 20%. And the other one is happy to go with 100%. Obviously, lender B will be able to get more loan opportunities because they're dealing with a wider range of potential borrowers. But that's okay because lender A has a risk profile that they want to have implemented in their lending program. So it's okay to be different. In fact, it's fundamental to be different. You should only have a program that reflects your own wants, desires, needs, and appetites. So not just counterparties, but also collateral. There's cash collateral, there's non-cash collateral. Within non-cash collateral, there is equities, government bonds, corporate bonds, and different investors have different views and perspectives on that. Of course, the widest possible collateral profile is more attractive than a more narrowly defined one. Again, an investor that has a more narrowly defined collateral pool will make less money than an investor that has a broader range. And of course, some investors will have exposure limits. So even if they're willing to deal with all of the counterparties, they may say that we don't want to ever have more than X for this borrower, that borrower, or all borrowers. So there's lots of differentiation, but that's investor risk appetite. Structurally, different investors of different legal types in different jurisdictions suffer different degrees of withholding taxes on dividends and interest payments. And because a borrower has to make a cash equivalent payment to a lender when it goes over a dividend payment or a interest payment date, obviously they want to pay as little money as possible because they just have to magic that money up. It's just a payment. They don't have any money coming in for that. So they're always looking for investors that have the most withholding tax possible just because it saves them money. Of course, it's not just that lenders have credit limits for borrowers, have credit limits for lenders, right? Borrowers have real ongoing exposure to all of the underlying lenders all of the time because they're getting 100 of securities they're borrowing in, but they're having to provide 102 or 105 or 110 or sometimes even more collateral to the lender. So a borrower is always exposed to a lender. It could be exposed to a borrower if a series of bad things happen, but it's only a potential, whereas for a borrower, it's real. So borrowers are required to have credit limits in place for all of the underlying clients. And so even then, they may not have credit limits for every one of them, or they may have credit limits, but they may have reached that credit limit. The next point is the netting opinions. So netting opinions really just in a nutshell says that within a legal jurisdiction, the laws of the country on the event of a default or a bankruptcy or insolvency, it says you've got loans and you've got collateral against those loans. And the question is, can they be offset to each other to create a bottom line net exposure, or are they looked at as two completely different things and you can't offset them? So if you can't offset them, then that means that credit limit usage is much bigger, means that it's much more expensive to trade with an investor that has a poor netting opinion or no netting opinion for their jurisdiction. So that's a critical factor. Doesn't cover that many markets, but it does cover some very big markets where some very big investors are located. And so it potentially has an impact on lending revenues and opportunities. And then finally, the final challenge, of course, is different service providers, the agent lenders, may have different distribution models. And of course, that can impact incomes and opportunities. So the real solution here is that from an agent lender point of view, what they need to do is create a standard methodology that they apply to their lending business and allocate it and apply it consistent so that you end up getting that same kind of approach trade by trade. And over time, those trades accumulate that should distribute the loan opportunities in a way that's consistent with whatever methodology that agent lender should or has put in place. And so this is often called a fair distribution algorithm, because once you've defined it verbally or written, then what you really want to do is you want to systematize it through technology, implement it, and have it applied to every loan. And that's why I really think it should be called a consistent distribution algorithm, because I think fair is such an arbitrary and wet word. It doesn't really mean anything. Who determines what fair is? So that's really the challenge. So that's the thought process. If we now look at the three main approaches, is first of all, allocation to a loan. So borrower comes into an agent lender. That agent lender has a pool. Actually, they have multiple pools, often based on the withholding tax for each of those pools, but that's maybe a little bit too complicated. So it goes to, want to borrow 100 shares of Apple. This group, of course, has 100 shares of Apple, and there's different ways of allocating it there. You could have underlying clients that get allocated individually based on their turn in the queue, or you could just have a proportionate share. So if someone is 1.1% of the Apple supply, they would get 1.1% of all Apple loan fees for a given day. Then the next day, that reallocation would happen, and maybe they're 1.05% or 1.2% based on the overall pool, and the fees would adjust the next day. So it could go either at the direct proportional level or an individual client allocation process. Other agents do a different model where it's individual clients. So the individual clients in the program get credit scoring, which I'll talk about in a second. And so each of them will get an opportunity to make a loan, but it goes client by client rather than via a pool. And then the third broad category is that there are client-specific solutions. And what that means is that it avoids any kind of queuing or algorithm. There's a direct relationship. A good example of that might be exclusives, where a certain portfolio or part of an overall portfolio gets allocated to a specific borrower. The borrower can just call up and borrow those securities. They don't need to go through any kind of allocation because the lender says this is already available to you. So it just goes straight through and skips the allocation process. Now, the theory about how this scoring works is that whether that's as part of a pool or an individual client allocation methodology, what happens is in that trade where you have client A and client B who could both satisfy that Apple transaction, the client that gets a debit score because they say you've got that loan opportunity. So now you are going to get a debit. You're going to go to the bottom of the queue. And lender B, you didn't get that loan. So now next time it seems only right that you get first opportunity for that. So they would get a credit score. And then what happens as subsequent loan opportunities come up, the investor with the highest score should get the next loan. Okay, that's the theory of it. But look, once that thought process has been mapped and applied systematically, there are always going to be exceptions. Where are those exceptions? Well, number one, sometimes a borrower will come in and say, I want to borrow from that specific underlying client of yours. What that means is that they have a specific preference for that. And so the borrower is determining where that loan is coming from. And why would they do that? They might have a good experience with one client who is a very stable portfolio, or it might be somewhere where they have good credit limits and they know that the credit limit is available for that. It might be any number of different reasons. Okay, so a borrower might do it that way. A borrower also might not necessarily pick the client, but they might say, I want to do this against cash collateral or non-cash collateral, or I can only give equities as collateral for this transaction. And so again, that filters out some of the clients that would normally maybe be at the top of the list. Maybe you have to skip them because they couldn't do that loan. So they have the shares, but they don't have the other criteria from the borrower. So there's lots of reasons for exceptions. And so an agent has to find some methodology for overseeing and dealing with those exceptions in order to determine whether they are valid exceptions. Now, the challenge is, all the bullet points on the left are from a previous slide. Like, the challenges that this throws up from an investor point of view, of course, is that since demand is very specific, two similar portfolios will generate different returns, even if everything else was equal. The reality is that two different portfolios will generate two different returns. Okay. So that's a challenge in trying to figure out how much revenue you will make, because there's no guarantee. If I want to borrow Volkswagen shares, showing me shares from Ford doesn't really do the trick, right? That's not going to be a loan. The second point, of course, is, as I said, investor decisions and selection criteria is probably the biggest influencing factor. As I said, borrowers also have their own preferences for many different reasons. I mentioned netting, which has a big impact for a small number of markets and a small number of big investors. And the business models, the three different approaches that I talked about that agents provide: the pooling, the individual client, or the client specific that skips the allocation process. All of those determine the bottom line income. And of course, transaction economics can make the difference. So what do I mean by that? If I have a borrow request for 100 shares of Apple, and the next client up, according to my scoring system, has 50 shares, and then I have another client who has 50 shares. If I do two market transactions, if I deliver 50 shares out for this client and 50 shares out for that client to satisfy the borrower's requirement, first of all, the borrower might say, no, I only want it in one delivery. I don't want to pay two settlement charges. So you have to find a client that does it in one. So there's an example where I might be willing to follow through in my algorithm, which says client A, then client B, 50 and 50, but the borrower says, forget it. So that's not my choice. So the economics impact it that way. Or I might determine that. I might say client A has 50, client B has 200. And so I'm going to make an exception. Even though client A is at the top of the list, I'm going to go straight to client B so I can make that delivery. And that's not a borrower requirement. That's my economic determination. Now, of course, client A, if they're at the top of the list and they don't get the loan, they'll get another credit score and stay at the top of the list. The challenge for some clients is, if they're small, they might stay at the top of the list forever and keep getting skipped because of exceptions. So that's why I'm also stressing, as with the bottom point there, that scoring isn't perfect and that the exception process needs oversight. So you need to understand how your agent lender reviews these oversights or these exceptions and how they manage them. Okay, so that's really critical, particularly if you're not the biggest client in the program. So that's really the summary of the key issues. I want to leave you with some thoughts and questions. As I said, the reality is that because securities lending is a secondary market activity, it's dependent on what's ever happening in the stock market or the bond market or derivative markets. And so you can never really with any certainty guarantee how much money a client will make. If you get a guarantee about a portfolio, what that really means is potentially it could be worth a lot more. And the guarantee is a floor figure that no matter what, it's going to be worth at least this much. So it's a different thought process there. But look, an explainable, consistently applied approach over time should generate that kind of reasonable, consistent allocation distribution to all of the underlying clients. Now, that might not happen in a day or a week or a month, but certainly if you're talking about months and years, that distribution should be clear and predictable in that sense. Of course, you have new clients coming into the program, leaving the program, portfolios change, yeah, criteria change, lots of things change. So it's a constantly moving target. But I think it's fair to say that a well understood and well automated program will generate consistent results. Now, as I keep stressing, there's always going to be exceptions. So understand the exception management process and challenge it. Also understand how the scores themselves are calculated. And look, here's an interesting question for you. If loan A is 100 shares of Apple, and loan B is what we call a collateral upgrade trade with evergreen features to it, it might be worth much more than the Apple shares in terms of nominal value, but the fees might be lower. In the case of Apple, maybe not, but if it was another stock that was more in demand, generating a higher fee, how would you compare, say, $1 million of value transaction in a stock that's making 100 basis points? How do you compare that to a government bond loan that might be outstanding for years, but only making 10, 12, 15 basis points? Okay. That's a really interesting question. So if, A gets a score and B gets a score, whether it's negative or positive, how do you compare those two transactions? I think that's a challenge. So should you benchmark all equity trades against all other equity trades? Should you benchmark all fixed income trades against other fixed income trades? Or is it okay on a portfolio basis? How do you take into account that a transaction in Apple shares might only last a couple of days, 2, 3, 4 days? How does that impact something compared to the government bond loan, which I said might last for years? Does that score take it into account? Well, I think that's a challenge. But are there ways of putting in sort of proxy equivalents? I think there are. So my final point on this is that retail investors change the game. It was a little bit over a year ago that I said one of the most important influential factors driving securities lending of the future was the participation of retail investors. Now, this was before GameStop, but I did mention actually Robinhood in the video that's on the YouTube channel. I'll put a link or addition or something to that video if you haven't seen it. But the retail investor portfolios don't look like institutional investors. They have different drivers and determinations. So retail investors, every time a broker comes in, starts offering securities for their underlying clients into lending programs or becomes a borrower, look, I think that improves the business over. These investors don't benchmark against other indices, and they don't have the peer group competition. They're just trying to make money for themselves. So retail investors are real game changers. Okay, so I'm really trying to encourage at every opportunity for greater participation of retail investors in the business. Of course, retail investors really need to learn more and understand more about securities lending and short selling. Like I can teach them about securities lending. I'm not going to be doing short selling courses in this venue in this way, although we are working on things to improve a general understanding, which you should see early in the new year. So I'm quite excited about that. But look, want to learn about securities lending? This is the place for it. You can see the link to our courses. Learn about the business there. We've had a bunch of people sign up again this week for the free primer. So hopefully you're getting value out of that. That's a less than 1 hour primer on securities lending. So look, let's just summarize for today. We were talking about the fair allocation methodology. The question is, do you understand how the agent lender that's lending those portfolios, do you understand how they allocate loans from multiple clients holding the same position? How does the revenue work out in that? So what's the allocation methodology? Look, the test for the algorithm is, can you actually explain it? Can the service provider explain how it operates? And then has that actually translated into a systematic technology-driven approach? There is no right or wrong way to actually do the allocation approach. You just need to understand how it's going to happen and make certain you ask questions about the methodology and what happens in the event of X or Y. Ceteris paribus, all things being equal, just doesn't exist in real life. So it doesn't matter how similar things are. There's never a duplicate, which means two incredibly similar portfolios would generate two different outcomes. And that's just the way it is. And then finally, I've given you some thoughts and ideas on how you can dig deep. And the reason you want to know is because it costs money or makes money any way you look at it. So you make certain you understand the situation. So that's it. Next week in part 31, we'll be talking about tri-party and bilateral collateral, what the determining factors are, what each brings to the table, why we still have two ways of doing things. So there's a lot of interesting material in that and good discussion stuff. Hope you enjoyed today's session and understand a little bit more about the allocation process. My name's Roy Zimmerhansl. Have a great weekend. Have a great week. I hope to see you in a future video, and feel free to ask questions. I get back to you pretty quickly. So thanks for joining me. And that, my friends, is a wrap.